Nobody likes losing money on investments, but in the case of stocks, there can be a silver lining. It's called tax loss harvesting. And done correctly, it can actually help reduce what your federal income tax bill is. So how does it work, and when is a great time to take a look at that approach? Tax loss harvesting is a strategy that turns investment losses into potential tax savings. And let's say you sell an investment for less than what you originally paid for it. That is called a capital loss. And with tax loss harvesting, you can use that loss to offset your capital gains. Those are the profits that you've made from selling other investments throughout the year. And this can be done ultimately to help lower your federal income tax liability. If your losses are bigger than what your gains are, or if you don't have any gains at all, you can even use up to $3,000 of those losses to offset your ordinary income. And the good news is you still have leftover losses greater than that. You're able to carry those losses forward into future years. You can technically harvest a loss, and you can look at gains anytime throughout the year, but waiting until the fourth quarter or waiting until about this time of year is oftentimes makes the most sense. And the reason being is right about now you have a better picture of your overall portfolio, your realized gains. You know kind of what your estimated tax liability is. And that way you can match those losses more strategically towards the end of the year. Here's the catch, though. You don't want to wait too long. So this is something that you don't want to miss the window on. And that's why smart people are meeting with their tax professionals right now. Because whatever you do tax-wise in your portfolio and the decisions that you make are decisions that need to be acted on before December 31st. You'll also, in this case, you want to understand what is called the wash sale rule. And what the IRS did is they created the wash sale rule to prevent investors from really gaming the system, if you will. And here's how that works. If you sell an investment at a loss, and then you buy back the same or a substantially identical investment within 30 days before or after that sale, it's a 60-day window, you can't claim that loss on your tax return. So that doesn't mean that you can't reinvest. Instead, you could buy something that maybe was in the same sector, like if you were in technology or if you were in healthcare. You could use an ETF or exchange-traded fund that provides similar exposure without being considered substantially identical. This way you can keep your money working for you while still capturing that tax benefit. So tax loss harvesting, it's an important thing to be taking a look at right now in your portfolio. If you have a taxable investment account, it can help you offset and reduce your federal tax bill. You can offset capital gains and even have the potential to write up to $3,000 against your ordinary income. And timing on this strategy does matter because, again, when December 31st strikes, that planning for the opportunity is closed really for this year. And then last, don't forget that wash sale rule. It can disallow your deductions if you repurchase too quickly or get something that's considered substantially the same. So if this strategy sounds like it could benefit you, what I would encourage you to do is have a tax what-if analysis run, scheduling that conversation with your investment advisor and or accountant today to see if tax loss harvesting fits into your overall plan. It can be a way to be, again, proactive and not reactive to your taxes. This isn't just about taxes. It's about making, smart investment decisions that align overall with your portfolio. And as always, before you make any changes with your taxes, always consult with your tax professional before you make any moves in your portfolio.